Okay, let's unpack this. Forget complex economic models for a second, because today we're diving deep into something much more fundamental, much more, well, human, how we feel about money, jobs, and the future.
Uh-huh.
Specifically, we're talking about the U.S. Consumer Confidence Index and why it's such a surprisingly powerful predictor of where the economy is actually headed.
That's right. And the numbers we've seen recently are, frankly, pretty striking. So listen to this. In March 2025, consumer confidence plummeted. I mean, it hit its lowest point in 4 years.
Wow.
And the reports tied it directly to rising fears of a recession and the persistent bite of inflation, especially with whispers of tariffs adding to the pressure.
4 years. That's not just a little dip. That's a really significant shift in the national mood, isn't it?
It really is.
But here's the twist, the kind of contrast that makes you stop and, think. Only a couple of months before that big fall, back in May 2024, we actually saw a noticeable partial rebound in that same index.
Exactly. So you have this fairly strong bounce back up in May 2024, followed by this deep slump almost a year later in March 2025.
Right.
It shows you how quickly sentiment can shift, sometimes based on unfolding events, sometimes maybe just on the prevailing mood sort of catching hold.
Which brings us to the core mission of this deep dive. Based on the sources you've shared, what do these numbers, these surveys that try to put a score on our collective feelings, actually tell us?
Yeah.
How much weight should we really give them? How optimistic or pessimistic we feel truly predict something as concrete as a recession, or maybe more simply, how we're going to open or close our wallets?
That's the million-dollar question, isn't it? Does widespread pessimism automatically mean everyone just stops spending?
Right.
And can optimism actually encourage us to loosen the purse strings, even if the underlying conditions haven't, changed that much yet?
Yeah.
It's about understanding if feeling translates directly or perhaps even leads action.
Right. So to understand how feelings might become reality, we first need to get a really solid grasp on this thing called the Consumer Confidence Index. What is it, fundamentally?
Okay. At its heart, the Consumer Confidence Index, or CCI, is a sentiment survey. In the U.S., the most widely followed one, the one everyone talks about, is conducted by the Conference Board.
The Conference Board.
Okay. Think of it as like taking the economic pulse of the nation's households.
Okay, so their goal is basically to gauge how people are feeling about their economic lives.
Precisely. Their core purpose is to measure how optimistic, or conversely, how pessimistic consumers feel about their current financial situation, their future financial prospects, and, well, the overall health and direction of the economy. It's less about tracking past behavior, like what they bought last month, and much more about capturing the present mood and the future outlook.
So it's like a gauge of the collective economic vibe. It's not tracking receipts from stores. It's tracking the mood that might lead someone to or not to buy something.
That's a great way to put it. And the fundamental premise behind it is quite logical, really. It's the idea that if consumers are feeling good, feeling secure in their jobs, confident about their future income, they are much more likely to spend money. When people feel optimistic, they buy cars, they book vacations, they renovate their homes. This increased spending is the engine of the economy. It stimulates demand, encourages businesses to invest and hire.
And the opposite scenario, pessimism.
Absolutely holds true. If consumers are feeling pessimistic, maybe they're worried about job cuts at their company, concerned about rising prices eating into their budget, or just have a general sense of gloom about the economy's direction. They tend to become very cautious. They'll likely cut back on non-essential spending, preferring to save money or maybe pay down debt.
Right.
This decreased demand can cause businesses to slow production, postpone hiring or investments, and if it's widespread enough, it can indeed contribute to an economic slowdown or even tip into a recession. The feeling here translates into holding back, into pulling back on that spending engine.
So this feeling to action link is why it's considered such a key barometer for the health of the U.S. economy.
Widely so, yes. The Conference Board's index is generally seen as a credible and, well, important gauge of U.S. consumer sentiment. It provides valuable insight into potential future economic trends.
And how do we read the number itself? I mean, what's the baseline? Is there a magic number?
Well, the index is benchmarked to a value of 100 back in the year 1985.
1985, okay.
So if the index reads above 100, it means consumers collectively are feeling more optimistic than they were back in 1985. If it's below 100, like that March 2025 reading of 92.9 we mentioned,
Yeah.
it indicates they're feeling more pessimistic than that 1985 starting point. It's a relative measure, giving some historical context to the current mood.
Okay, that helps set the stage. But how do they actually get this number? How do you measure a whole nation's feelings? It sounds a bit, well, abstract.
It's a fair question. It does sound abstract. Let's peek behind the curtain a bit at the methodology. The CCI is based on a monthly survey conducted by the Conference Board. They use a data collection partner, like Nielsen, to actually reach out to households across the country.
How many households are they surveying? Are we talking thousands?
Yes, the sources mentioned sample sizes, typically around 3,000 or maybe 5,000 households each month. The goal is to get a sample that is representative of the broader U.S. population.
And they don't just ask, how are you feeling about the economy?
Right.
It must be more specific than that. What are the actual questions that go into this index?
No, you're right. It's more granular than that. The index is constructed from responses to 5 very specific questions. These 5 questions are then grouped into 2 main sub-indices that make up the overall CCI.
Okay, tell us about those components.
First, there's the Present Situation Index. This accounts for 40% of the total weight of the overall CCI.
40%.
Yeah. It's based on 2 questions that ask consumers for their assessment of current business conditions and current employment conditions. Essentially, how do things feel right now in their immediate economic environment?
Got it. So 40% is based on today. What about the other 60%? That's the bigger chunk.
That's the Expectations Index. This is the forward-looking part, and it carries more weight, 60% of the total CCI. It's derived from the remaining 3 questions, which probe consumers' expectations regarding business conditions, employment conditions, and their total family income 6 months down the road. What do they anticipate happening in the near future?
So it's weighted more heavily towards the future outlook than the current reality. That feels significant if it's meant to be a predictor.
It absolutely is. The future expectations carry more weight because, well, hypothetically, they should be a better indicator of future spending plans than how people feel about conditions that have already occurred.
That makes sense. And how do they turn these positive, negative, or neutral answers into an index number like that 92.9 we saw?
Okay, the calculation process is a bit technical, but the core idea is manageable. For each of the 5 questions, they calculate something called a relative value. This is essentially the proportion of positive responses relative to the sum of positive and negative responses.
Okay.
Then they compare these monthly relative values to the average relative values recorded way back in that 1985 benchmark period, which, as we said, is set to an index value of 100.
Right, the baseline.
Exactly. This comparison gives them an index value for each of the 5 individual questions.
Okay, so they normalize each question's result against that 1985 baseline. Got it.
Precisely. And then those 5 individual question index values are combined. The overall CCI is a weighted average of these 5, using that 40% weight for the 2 present situation questions and the 60% weight for the 3 expectations questions.
Right.
The present situation index is just the simple average of its 2 questions, and the expectations index is the average of its 3. So it's a standardized, weighted calculation against a historical benchmark.
That simplifies it nicely. It's not just a vague gut feeling poll. There's definitely a method to it. Now, you mentioned something earlier that sounds really important about interpreting these numbers. It's not just about the latest figure, right?
Crucially not. This is perhaps the most important practical takeaway when you're looking at CCI reports. You must look at the trend of the index over several months. Don't just fixate on a single month's number or only the change from the previous month.
So less about, oh, it's up 2 points this month, and more about the pattern over, say, half a year or something.
Precisely. The trend over, say, 4, 5, or even more data points gives you a much clearer picture of where sentiment is genuinely heading. It smooths out any, month-to-month volatility or potential sampling noise that can happen. The sources highlight that significant changes, typically defined as 5% or more in either direction, are what often signal a meaningful shift in the economy's direction.
Okay, a 5% move is something to pay attention to.
Yes. Be very wary of economic commentary that hypes up or dismisses a report based on just 1 month's small change. Look for that sustained movement.
That's a fantastic piece of advice. Look for the sustained direction. And you mentioned potential for bias or subjectivity. Looking at the trend helps mitigate that too, I suppose. If 1 month's sample is slightly off, the trend will show that.
It does. People's moods can swing, based on headlines or how they interpret a question might vary slightly from month to month. Focusing on the consistent movement across a large sample over time gives you a much more reliable signal.
Okay, with that foundational understanding, let's dig back into the recent data we started with. What were the specifics from that March 31st, 2025 report that sent the index tumbling to that 4-year low?
Right. The overall CCI in that report declined by a noticeable 7.2 points, landing at 92.9. That drop was indeed significant, well over that 5% threshold we just talked about. And the report directly attributed this decline to rising consumer fears, specifically fears of a recession and concerns about persistent inflation. And the prospect of tariffs was mentioned as adding another layer of worry.
So fear was really the dominant emotion driving the number down. Which component showed the most dramatic shift? Was it the present or the future?
It was definitely the expectations index. It saw a particularly sharp decline. It fell by a significant 9.6 points, dropping all the way down to 65.2.
65.2. And you said there's a level that often signals recession?
Yes, this number is particularly noteworthy because historically, a reading below 80 in the expectations index has often signaled a forthcoming recession. At 65.2, that's considerably below that warning level.
Wow.
It was also the lowest reading for the expectations index in a full 12 years.
12 years. That really underscores the depth of pessimism consumers were feeling about the future economy back in March 2025. That's a serious red flag if the index really is a leading indicator.
It certainly looks like one in this case.
But wasn't there a slightly conflicting signal in that same report about how people felt about the current job market? Didn't that actually improve a bit?
Yes, that's one of those nuanced details that makes analyzing this data so fascinating. The perception of the current labor market, measured by what's called the labor market differential, which is the difference between the share of consumers saying jobs are plentiful versus those saying jobs are hard to get. That actually saw a slight increase. It rose to 17.9 from 17.1.
Wait, hold on. So people felt slightly better about finding a job right now in March 2025, but dramatically worse about the job market and the economy 6 months down the road. That feels really counterintuitive.
It does, doesn't it? And it highlights that consumer sentiment isn't always perfectly aligned with current statistical realities. You might have low unemployment now, but people can still fear it won't last. And the sources make a crucial point here. It doesn't necessarily matter if consumers are statistically right or wrong about the likelihood of a recession or the future state of the job market. If they believe it, if that fear takes root, and it causes them to change their spending and saving habits, then those fears can absolutely contribute to bringing about the very economic slowdown they're worried about.
The belief becomes the behavior.
And the behavior can influence the outcome. It's that self-fulfilling prophecy idea again.
That concept is really powerful when you think about millions of people acting on that feeling. What else did that March 2025 report reveal about people's personal financial outlooks?
Well, optimism about their future income prospects pretty much evaporated, gone.
Oh, wow.
Consumers also turned negative about the stock market for the first time since late 2023. Concerns about rising interest rates hit their highest level in 2 years, which was again linked in the report to worries about tariffs and the resulting higher prices for everyday necessities.
Like food prices.
Exactly. The example of eggs was specifically mentioned, showing how these micro concerns, these everyday price points, can really tie into the macro sentiment.
Yeah, that hits home.
And assessments of their own family's future financial situation weakened significantly, reaching the lowest level since July 2022. So future financial outlooks across the board were decidedly gloomy.
With that kind of pessimism, what did consumers say about their plans for making big purchases in March 2025? Did they just slam the brakes?
Plans for purchasing major items like homes and cars were down, which isn't surprising, right, given falling confidence and rising interest rate concerns.
Makes sense.
But interestingly, plans for other big-ticket items, specifically appliances and electronics, actually saw a slight increase.
That is surprising. Why would people plan to buy, say, a new washing machine or TV when they're feeling so pessimistic about the economy and their own finances?
The source offers an intriguing potential explanation. This might reflect consumers trying to buy ahead of anticipated price increases, perhaps due to those feared tariffs.
Ah, the buy it now before it costs more effect.
Exactly. If they believe tariffs are coming and prices for imported goods like electronics or appliances will go up, they might decide to make those purchases sooner rather than later, essentially trying to lock in the current prices.
Okay.
The report also noted that consumers intended to spend more on services, specifically mentioning leisure activities like movies and live entertainment.
So maybe pulling back on huge long-term commitments like cars and houses, but still willing to spend on immediate experiences or trying to get ahead of future price hikes on goods.
It seems like a nuanced picture, yeah. driven by a mix of fear, price expectations, and maybe a need for some immediate comforts or distractions.
You brought up the May 2024 data earlier as a point of contrast, showing that rebound. What did that report show specifically?
The May 2024 report showed a solid partial rebound in the overall CCI. It increased by a robust 12.3 points.
Oh, a decent jump.
Yeah. And while that was nearly a year before the big drop in March 2025, it just illustrates how consumer sentiment isn't static. It can shift direction relatively quickly, sometimes influenced by recent economic news or perceived changes in trajectory.
Yeah.
Emphasizing why watching the trend over time is so crucial rather than just 1 month's reading.
Definitely shows the volatility. Were there significant differences in how various groups of consumers felt in that March 2025 report, the one with the big drop? Did everyone feel the pessimism equally?
No, there were some notable distinctions. The decrease in confidence in March 2025 was reportedly led by consumers over the age of 35.
Older consumers. Interesting.
Yeah. And it was also pretty broad-based across income groups, meaning most income brackets saw their confidence decline. However, there was one significant exception. Consumers earning more than $125,000 a year.
The highest earners.
Right. Their confidence did not show the same broad decline. Now, this contrasts slightly with earlier reports mentioned in the sources, like the January 2025 data, where confidence had actually declined most sharply for those earning over $125K. So it seems by March 2025, the highest income group perhaps felt relatively more resilient or less impacted by the prevailing fears compared to other groups.
That's interesting how it shifted. Now, you mentioned that May 2024 report, the one with the rebound, had a special question about actual behavior.
Yes, exactly. It gave us more insight into how different income groups were actually acting in terms of spending and saving at that time, which is really valuable context.
What did that special question reveal about income differences back then?
Okay, so overall, in May 2024, more than a third of consumers, 36.7%, said they had put money aside for future spending, which sounds like a good sign for future demand, right?
Yeah, potential fuel in the tank.
But around a quarter, 26.6%, said they had actually dug into their savings to cover expenses, and a similar proportion, 26%, reported postponing major purchases.
So a significant split, some saving for the future, but quite a few already feeling the pinch or delaying big buys even during that rebound period.
Exactly. But when you looked at the income breakdown from that May 2024 special question, the difference was stark. Consumers in households making over $125,000 a year were significantly more likely than any other income group to report that they had saved money. On the other hand, less wealthy households were more likely to say they had either used their existing savings or postponed major purchases.
That makes intuitive sense, unfortunately. Higher earners often have more disposable income buffer, more capacity to save even when things feel uncertain. Lower and middle-income households feel budget pressures much more acutely and are often the first to have to cut back or dip into savings when uncertainty rises.
Precisely. And that same special question in May 2024 also touched on buying ahead of price increases, which ties into our discussion about the March 2025 data and those appliance purchases. Only 19% of consumers overall said they had made advanced purchases ahead of anticipated price increases back in May 2024. But again, the share was higher for wealthier households at 26%.
So even the idea of buying ahead seems more feasible for higher earners.
It suggests that anticipating inflation or tariffs impacts purchasing decisions differently across income levels. Yeah, higher earners potentially have more financial flexibility to act on those expectations.
Okay, so these spending and saving patterns are really where the rubber meets the road, right? This is where the feelings about the economy start translating into actual economic activity.
Precisely, and we can connect this directly back to the actual data on personal income and spending that was released around the same time as that March 2025 confidence report, specifically looking at the February 2025 figures.
Okay, let's look at that. What did the income data show for February 2025?
Personal income in February 2025 actually increased by a relatively strong 0.8% compared to the previous month.
0.8%. That sounds pretty good.
It was notable because it actually exceeded market expectations, which were around 0.4%, and it was also higher than the revised gain in January, which was 0.7%. So income growth looked pretty healthy on the surface.
So incomes were rising faster than expected. That seems like it should support confidence in spending, shouldn't it?
It does, but there was a significant nuance that the sources highlighted, a kind of asterisk on that number.
Yeah, okay. What was it?
A substantial portion of that income growth in February, $49 billion, to be precise, came from one-time settlements.
One-time payments?
Yeah. Specifically, a large payment from a domestic medical device manufacturer and another one from a social media company. Without these one-off infusions, the monthly personal income growth would have been a more moderate 0.6%.
Okay, 0.6%, still positive growth, but not quite the blockbuster 0.8%.
Right, still slightly above what expectations were, excluding the settlements. But the headline number was definitely boosted by these unique events. It wasn't broad-based wage growth driving it all.
Gotcha. Okay, so underlying income growth was okay, but the big headline number was inflated by special factors. How did this translate into actual spending in February 2025?
Well, personal spending in February 2025 rose by weaker than anticipated 0.4%.
Only 0.4%. The market expected 0.5%.
Right, and this followed a revised decline in spending back in January, which had dropped by 0.3%. So spending did rebound slightly after that January dip, but not as robustly as many analysts expected, especially given that seemingly strong income growth figure, which, as we just discussed, had that one-off boost.
So people got more income, some of it temporary, but they didn't necessarily rush out and spend it all?
Seems that way. And there were particular areas where spending shifted quite dramatically.
Like what?
The details revealed a really fascinating reallocation of consumer dollars. Spending on goods saw a significant increase, rising by a strong 0.9% in February.
Good spending up almost a full percent.
Yeah, a big jump. And this was largely driven by spending in categories like motor vehicles and parts and recreational goods and vehicles.
Cars and RVs and things.
Exactly. This data point directly supports the idea we discussed from the confidence survey that some consumers were actively buying durable goods, possibly trying to beat those anticipated future price increases from things like tariffs.
Okay, so the buy-ahead theory gets some backing there. What about services?
That's where the story flips. Spending on services actually decreased in February for the first time since January 2022.
Decreased. Wow.
Yeah. In real, inflation-adjusted terms, services spending dropped by 0.1% for the month. The sources noted a particularly sharp drop in spending at nonprofit institutions, a decrease of $15.8 billion in February. That was the largest decline seen in that specific category since November 2020, right in the midst of the pandemic disruption.
So people were buying cars and maybe RVs or electronics, possibly trying to beat future price hikes, but pulling back on things like charitable donations or perhaps certain forms of healthcare or education services that fall under nonprofits.
That's what the data strongly suggests. A clear shift from services, where spending pulled back, towards goods, where spending actually accelerated, driven by specific categories, often susceptible to price speculation or just large one-time purchases.
Fascinating. And what happened with the amount of money people were setting aside? The saving rate?
The personal saving rate actually rose in February 2025. It increased to 4.6% from 4.3% in January.
Okay, saving more.
Yeah, and this represented the highest saving rate since June 2024. This increase in saving directly reflects consumers holding on to a larger proportion of their income, which aligns perfectly with that falling confidence we saw in the March survey data, particularly that deep pessimism about future economic conditions.
So it all ties together.
It really does. This combination of weaker than expected overall spending growth, despite those income boosts, the shift from services to goods, possibly tariff-driven, and the increase in the saving rate. It all ties back to that critical idea we keep circling: consumer expectations, even if they seem to conflict slightly with current statistics. It's like the slight improvement in current job sentiment versus the deep future fears. They can become self-fulfilling. If people are worried about the future, they save more and spend less, cautiously. This collective pullback in spending can indeed slow down the economy and potentially contribute to the very downturn they feared. It's a powerful feedback loop.
The feeling becomes the reality. So let's zoom out now. Why does this consumer confidence index and these underlying spending and saving patterns matter so much for the economy as a whole? What's the big picture impact?
It matters immensely because consumer spending is, and this isn't an exaggeration, the primary engine of the U.S. economy. It consistently accounts for about 65% of total U.S. gross domestic product, or GDP.
65%. Wow. So basically 2/3 of the entire U.S. economy is driven by what we as consumers decide to buy or not buy.
Exactly. That number tells you everything you need to know about why consumer confidence isn't just some interesting statistic for economists to debate. It's a critical signal of consumers' willingness and ability to spend and save, which directly dictates the pace and direction of overall economic activity.
So how do different parts of the economy, different economic actors, actually use this information? Businesses, for example.
Oh, they watch it incredibly closely. Businesses from huge manufacturers building products down to the local retailers selling them track CCI trends to try and anticipate changes in consumer demand.
Makes sense.
A rising trend is like a green light. It signals that consumers are feeling confident and likely to increase their spending. This might prompt businesses to ramp up production, increase inventory, maybe hire more staff.
And if it's falling, like in March 2025,
Conversely, a decreasing trend, like the one we saw, suggests consumers will likely pull back, especially on discretionary items or big-ticket purchases. This can lead businesses to pare down inventories, maybe delay capital investments, or shift their marketing focus towards value-oriented products and services to meet those cautious consumer budgets.
what about the financial sector? Banks.
Banks pay very close attention. A rising CCI trend suggests increased demand for various forms of credit, things like personal loans, mortgage applications, maybe higher usage of credit cards for purchases.
Okay.
A decreasing trend signals the opposite is likely coming, potentially meaning lower loan demand and perhaps increased caution in their own lending standards.
And builders, people building homes.
Builders also monitor it closely. Rising consumer confidence, particularly if you see improvements in that future financial situation component of the survey, can signal increased consumer readiness for home purchases.
Yeah.
That might allow builders to prepare for a potential rise in residential construction activity.
And the government, policymakers, do they watch this?
The government certainly keeps an eye on it. A rising trend usually indicates increased consumer spending, which generally translates into higher tax revenues, sales tax, income tax eventually.
Right.
A downtrending index, particularly one that flashes those recession warnings like the expectations index did in March 2025, might prompt policymakers to consider various actions to stimulate the economy.
Like what?
This could involve fiscal measures, maybe proposing tax rebates or increased government spending programs, or it could influence monetary policy decisions like interest rate adjustments by the Federal Reserve. The Fed, for instance, is known to consider consumer sentiment as one of several important indicators when they're evaluating the health of the economy and contemplating rate changes.
So it's not just a report card on past performance. It actively influences decisions being made by companies and governments about the future.
Absolutely.
Now, is the CCI generally seen as predicting the future, being a leading indicator? Or does it just reflect the present, maybe lagging a bit? What's the consensus?
That's actually a point of ongoing discussion among economists. Some do view it primarily as a lagging indicator, suggesting it simply reflects economic conditions that have already changed.
Yeah.
However, influential bodies, like the Organization for Economic Cooperation and Development, the OECD, they classify consumer confidence as a leading indicator.
A leading indicator, so like a warning sign.
Exactly. They see it as providing an early warning of potential turning points in overall economic activity. And as we discussed earlier, those changes of 5% or more in the index are often considered significant signals of a potential shift in direction. So while the debate exists, many analysts and organizations do rely on it, specifically for its potential to forecast future economic movements.
Okay. Beyond the CCI survey itself, what other economic signals do analysts typically look at alongside consumer confidence to get a more complete picture of where things might be headed? It can't be the only thing they look at.
Great question. No, it's definitely not the only thing. The CCI is powerful, but it's really one piece of a larger puzzle. Several other vital economic metrics correlate with and help us understand both consumer sentiment and actual spending behavior.
Like what?
Well, retail sales, for instance.
Yeah.
That's a direct measure of consumer spending at stores, right? Strong, increasing retail sales generally align with high consumer confidence. Declines suggest confidence is waning and people are tightening their belts.
Makes sense. Direct spending data.
Then there's the overall GDP growth rate. That's fundamental. A healthy, growing economy typically means higher incomes, greater job security, and that tends to boost consumer confidence and spending capacity. Slowing or negative GDP growth obviously does the opposite.
And we've seen how sensitive confidence is to prices, so inflation must be key.
Absolutely critical. The inflation rate directly impacts consumers' purchasing power and their confidence. Persistent inflation, especially in core goods and services, erodes budgets and makes people feel poor, even if their income is rising slightly. The core PCE inflation measure, that's personal consumption expenditures excluding volatile food and energy, is a key gauge the Fed watches closely. For the period around that March 2025 report, the sources noted that core PCE inflation measures actually exceeded expectations in previous figures.
So inflation was sticky.
Exactly, indicating persistent price pressures. Specifically, the February data reported in late March showed monthly core PCE rose by 4.3% and annually by 2.8%. And high prices for everyday things like those eggs mentioned in the Conference Board survey are very real concerns that hit consumers directly and really dent confidence.
Yeah, it's hard to feel confident when your grocery bill keeps climbing.
What about the job market beyond just the consumer's perception in the survey, the actual number?
Actual unemployment rate and job growth figures are huge drivers of confidence. Low unemployment increases confidence and spending potential because people feel secure in their jobs and incomes.
Rising unemployment, or even just a noticeable slowdown in job creation, can quickly erode confidence and force consumers to cut back, focusing spending strictly on essentials. Reports like the monthly employment report are major market events, specifically because of their impact on consumer sentiment and economic forecasts. Everyone watches those numbers.
Right, like the March report they were anticipating back then expected 135K jobs and 4.1% unemployment. Big numbers to watch.
Exactly. It's also insightful to look at business capital spending, even though that's not consumer behavior directly. Investment by businesses in new equipment, technology, or facilities is another key form of consumption or demand in the economy.
Okay.
And dramatic changes in corporate investment can sometimes be a leading indicator for the broader economy, occasionally even signaling shifts before consumer behavior fully adjusts.
Why would business spending lead consumer spending sometimes?
Well, large corporations often have sophisticated forecasting models and maybe can be quicker to react to anticipated changes in demand. If they foresee a slowdown coming, they might rapidly pull back on investment plans, hiring, or inventory buildup before consumers have fully changed their habits.
How do we see that?
This is reflected in things like the Purchasing Managers Index, or PMI.
Ah, the PMI. How does that reflect business sentiment?
The PMI surveys purchasing managers at companies about their activity. Are they seeing more new orders? Are inventory levels rising or falling? Production? Employment.
Okay.
A reading above 50 signals expansion in the manufacturing or services sector, while below 50 signals contraction. It historically ranges from about 40 to 60, usually. A PMI reading dropping below 50 is often seen as an ominous sign of reduced corporate appetite for investment and expansion, which is directly tied to their sentiment and their forecast for future economic activity and consumer demand.
So below 50 is a worry sign from businesses.
Generally, yes. We also look at specific direct spending metrics for particular categories, like purchases of durable goods, think appliances, furniture, electronics, and autos.
Right, the big ticket items.
While these are narrowly defined parts of overall consumer spending, they correlate very strongly with general consumption trends. The sources reference the example of the 2001 recession, where steady consumer spending, partly supported by things like generous auto financing deals, helped fuel auto sales and actually contributed to the economy's eventual recovery from that recession. So tracking these specific categories can give you a clearer view of what people are still buying or cutting back on first.
Interesting. Anything else?
Finally, there's a more qualitative measure of corporate sentiment you can kind of keep an eye on: corporate auxiliary spending.
Auxiliary spending. What's that?
This refers to discretionary spending by companies on services like advertising, consulting, IT support, business travel, things that aren't core production. If corporations are feeling pessimistic about future demand and the economy, these are often the first areas where they start to trim budgets.
So if you hear about widespread layoffs or significant slowdowns in industries like advertising agencies or IT consulting firms or maybe corporate legal services, that's essentially a reflection of weak corporate sentiment and their expectation of lower demand.
Absolutely. Cutbacks in these areas signal that companies have a weak forecast for future demand and a reduced appetite for discretionary spending themselves. Looking at the financial performance or hiring trends of companies in these specific industries can provide a pretty good proxy for overall corporate sentiment, which, just like consumer sentiment, is a key driver of the economy.
So the Consumer Confidence Index is a vital piece, but its real power is seen when you put it alongside these other real-world spending, hiring, inflation, and investment indicators. They all help paint a more complete picture, validating or maybe complicating the CCI signal.
Exactly. They either confirm the signal from the CCI or perhaps suggest a different nuance you need to consider. Now, let's take an even deeper dive, maybe drawing on some of the academic research you shared, to really understand the specific factors that determine how consumers behave and spend during those really tough economic downturns. What does the research tell us about why people cut back when times get tough?
Okay, good idea. How does spending actually change when the economy enters a recessionary period? What's the typical pattern?
Well, academic studies consistently confirm what intuition probably tells you. During recessions, consumers made significant changes to their spending patterns. The most obvious one is a sharp reduction in discretionary spending. The wants, things like dining out, new clothes, vacations, maybe delaying buying that new car or those electronics we talked about.
Right, cutting back on
And
non-essentials.
prioritizing essential goods and services and needs, like groceries, housing costs, utilities, necessary health care. Survival mode, essentially.
That makes intuitive sense. What are the key factors that research identifies as influencing how much and where people cut back during these times? It can't be the same for everyone.
No, definitely not. Several factors stand out clearly in the research. Income levels are absolutely crucial. Research consistently shows that lower-income households are disproportionately affected by downturns. They tend to cut back their spending much more significantly than higher-income households.
Why is that?
They simply have less flexibility, less of a financial cushion to absorb shocks like job loss or rising prices. This aligns perfectly with that May 2024 survey data we discussed earlier, showing less wealthy households were more likely to have used savings or postponed purchases compared to wealthier ones who are actually more likely to increase savings.
Right. What about savings and debt going into a recession?
Yeah, savings and debt play a major role. Consumers who enter the downturn with significant existing savings are often better able to maintain their spending levels, at least for a while. They can draw down on that cushion.
Makes sense.
Conversely, households burdened by high levels of existing debt mortgages, credit cards, student loans, face increased pressure to cut spending because a larger portion of their income is already committed to just servicing that debt. They have less room to maneuver.
Job security seems like it would be front and center during a recession. The fear factor.
Absolutely. Job security and unemployment are perhaps the most potent determinants of consumer behavior during a downturn. Uncertainty about one's own job, or even just the general perception of rising unemployment in the news and the economy, profoundly influences cautious spending habits. Rising aggregate unemployment rates directly trigger consumers to focus on essential purchases and delay or cancel pretty much anything non-critical.
Yeah.
The fear of job loss is a primary psychological driver of this behavior, maybe even more than the actual job loss itself for many people.
You mentioned psychological factors earlier when talking about the self-fulfilling prophecy. What other psychological elements influence spending during downturns, according to the research?
Well, beyond the direct fear of job loss, broader psychological factors are key. General economic uncertainty, just a pervasive sense of pessimism about the future, a loss of confidence in the economy's trajectory. These are powerful drivers of reduced spending, independent of someone's actual current income.
Right, the overall mood.
And behavioral biases identified in behavioral economics are highly relevant here. For example, loss aversion. The tendency for the pain of a loss to feel much stronger than the pleasure of an equivalent gain.
Yeah.
That makes consumers highly risk-averse during downturns. They prefer to hold on to what they have, which means saving rather than risking spending money they might need later. Herd mentality can also amplify behavior. If everyone else seems to be cutting back and talking about recession, individuals might follow suit even if their personal situation isn't objectively dire yet.
Following the crowd.
Exactly. And the research suggests that targeted interventions, like clear communication from authorities or direct financial aid, might be necessary not just for pure economic reasons, but also to alleviate these psychological anxieties and help restore a baseline level of confidence.
So it's not just the numbers, the unemployment rate or income data, but the fear and the mindset that really drive the behavior in a downturn.
Exactly. The psychology is deeply intertwined with the economics. Interestingly, research also highlights the influence of cultural factors.
Cultural factors, how so?
Studies suggest that cultural norms and societal structures can significantly shape attitudes towards spending and saving behavior, particularly during periods of uncertainty. Some cultures might have stronger historical traditions of frugality, or perhaps more robust family or community support systems that influence individual decisions differently than in other places. This reinforces the idea that economic policies and even marketing strategies might need to be tailored to specific cultural contexts to be truly effective. A one-size-fits-all approach might not work everywhere.
That's a fascinating layer. What about the impact of technology during these times? Does the internet change how we react?
The role of digital platforms is increasingly significant, according to the research. Social media and online reviews are found to exert a strong influence on consumer purchasing decisions, especially when economic uncertainty is high.
Why is that?
Well, consumers may rely more heavily on peer recommendations and online feedback to feel more confident about the value or necessity of a purchase when they're feeling less secure financially. They're looking for validation or maybe just trying to make sure they're getting the best deal.
Makes sense. More research online.
Yeah. For businesses, this means maintaining a strong digital presence and fostering positive online engagement are absolutely crucial for building trust and maintaining visibility during downturns. You need to be where your customers are looking for answers.
And government actions, we know they matter for stimulating the economy overall, but what does the research say about their specific impact on consumer spending during a recession? Do things like stimulus checks work?
Government interventions are found to be quite impactful, yes. Studies, like the one by Patel and Singh referenced in the source material, indicate that targeted fiscal stimulus measures things like direct cash transfers to households, the stimulus checks you mentioned, or perhaps temporary tax rebates can be effective tools for bolstering consumer spending during a slump.
How do they help?
These measures can provide a direct financial cushion that enables continued spending, especially on essentials, or it helps alleviate the need for households to dip into already depleted savings or delay necessary purchases. The research really emphasizes that the timing and targeting of these measures are critical for maximizing their effectiveness in mitigating the negative effects of a recession on consumer demand. Getting the money to the right people at the right time matters.
So it's clear that consumer spending behavior during challenging economic times is driven by this really complex web of financial realities like income and debt, psychological states like fear and confidence, broader societal and cultural influences, technological impacts like online reviews, and government policy responses. It's far, far more than just a simple reaction to the latest unemployment figures.
Absolutely. It's a deeply human phenomenon interacting with complex economic forces.
How do these findings about what drives spending during downturns connect back to broader economic theories we might have heard about?
Well, they align with and provide really good real-world examples for several key economic schools of thought. Keynesian theory, for example, is directly supported by this. The whole idea that widespread consumer pessimism leads to a decline in aggregate demand, which then requires government intervention like fiscal stimulus to counteract and stimulate spending. That's classic Keynesianism in action. Behavioral economics, as we touched on, provides the theoretical framework for understanding all those psychological factors and biases, loss aversion, herd mentality, the power of fear that lead consumers to cut back, sometimes in ways that might not seem purely rational from a traditional economic viewpoint, based solely on income or prices. It explains the human part. And the permanent income hypothesis, which is the idea that consumers base their spending not just on their current income, but on their long-term income expectations. Well, that's relevant too.
How so?
If a recession is perceived as temporary and consumers believe their long-term income stream is basically secure, they might smooth their consumption and not cut back as drastically. That's the theory. However, if the pessimism is deep-seated, as indicated by a really low expectations index, and consumers genuinely fear long-term job loss or reduced future income potential, then their behavior aligns more closely with the observed recessionary pattern, where spending does drop significantly because their permanent income expectation has actually decreased. The depth of the pessimism really matters for how much that permanent income hypothesis holds true in practice.
Okay, so based on all of this, the index itself, the recent data, the correlation with other economic signals, and this deeper academic research on recessionary behavior, what are the key practical implications? What should businesses and policymakers actually do with this knowledge when navigating these trends?
The sources offer some valuable insights and recommendations for both groups. For businesses, navigating a downturn driven by cautious consumers is really all about adaptation. It means being flexible and pivoting strategies.
How?
Potentially focusing more on value-driven products or services that meet essential needs, rather than pushing high-end luxury items. It involves recognizing and responding to shifting consumer values, like that interesting trend towards prioritizing environmental sustainability, even during financial hardship that some research pointed out.
Right.
Crucially, businesses need to deeply understand and respond to consumer sentiment itself. Monitor the CCI, yes, but also listen through other channels. And leverage digital platforms effectively for engagement and building trust, especially when traditional interactions might be reduced or consumers are feeling more skeptical.
So adapt, focus on value, maybe sustainability, and stay connected digitally. What about for policymakers?
For policymakers, the clear implication from the research is that targeted fiscal stimulus measures remain vital tools to help boost both consumer confidence and actual spending during slowdowns. Things like those checks or rebates can make a real difference.
Targeted being the key word.
Targeted, yes, and timely. The research also reinforces that supporting areas like environmental sustainability initiatives or helping small businesses weather the storm can also contribute to a more resilient economy overall. Policies need to be carefully designed, informed by this complex understanding of the economic and psychological drivers of consumer behavior to effectively cushion downturns and support a durable recovery.
This has truly been a deep dive into what lies beneath that single consumer confidence index number. It's way more complex than it looks at first glance.
It really is. It's much more than just a data point. It's a powerful, albeit sometimes volatile, snapshot of how millions of people feel about their economic future. And those feelings, as we've seen, are critical drivers and even predictors of actual economic activity.
Yeah.
They influence everything from whether a family decides to take on a new car payment to the overall pace of national GDP growth.
And the overarching lesson here seems to be that consumer spending behavior, particularly when the economy faces headwinds like potential recessions or persistent inflation, isn't dictated by just one or two simple economic factors like current income or the unemployment rate.
Not at all.
It's this incredibly complex interplay of those economic realities, deeply ingrained psychological states like fear, optimism, and uncertainty, broader social and cultural influences, the increasing impact of digital technology, and, of course, the effects of government policy responses. It's a whole ecosystem.
Understanding this interconnected web is absolutely essential for anyone trying to make sense of economic data, whether you're forecasting market trends, running a business, making policy, or even just trying to manage your own financial life in what can feel like a pretty volatile world. It's a profound reminder that the economy, at its very core, isn't just numbers and charts. It's driven by human decisions and, crucially, human feelings.
So here's a final thought for you, our listener, as you reflect on this deep dive. Think about the last time you felt genuinely worried about the economy or perhaps your own financial future. Did that feeling actually change your spending habits, even just slightly? Maybe you put off buying something, decided to save a bit more aggressively, or switch to a cheaper brand at the grocery store? How might your own personal experience of that link between feeling and behavior echo the larger trends and the complex factors we've explored today?